Hi, everyone. Welcome to Eyes Wide Open Viewer Trade Clinic. In this series, I analyze specific trades just like I do for my one-on-one coaching clients. Today's question comes from Don in Wilkesboro, North Carolina. Don has a position in an S&P mid-cap ETF and is considering adding another $3,000 to his investment. Here's what he wrote. I put $5,500 of my portfolio into XMHQ a few months ago, believing midcaps would do well in this environment. It has performed badly for me, but shows strong long-term performance over 5 years or more. I don't want to give it up yet. I'm considering supplementing it with about $3,000 in SPMD. There's about a 22% overlap. This would be a long-term investment, maybe 5 years. I'm retired. Since Don isn't here to answer follow-up questions, I'll have to make some educated guesses about his goals. Here are some key questions I would normally ask. How many shares of XMHQ do you own? Why did you choose this particular fund? How much did you pay for it, and what's the current share price? What is the current share price of SPMD, and why are you considering it? Are you open to using options to boost returns and reduce risk? Would you consider a different mid-cap ETF to meet your goals? Without those details, I'll offer two possible approaches, a buy and hold strategy and a way to incorporate options for additional income. If you want to stick with a buy and hold strategy, here's the key takeaway. XMHQ and SPMD trade in alignment, and both are already diversified within the mid-cap sector. Because of that, you don't need to add SPMD. Simply adding to your existing XMHQ position could be the easiest way to take advantage of the pullback and lower your average cost per share. That said, if you really want two funds, buying SPMD won't hurt, but it likely won't make a meaningful difference in your overall returns. Since you're retired, I'd also encourage you to consider a dividend fund instead. By reinvesting the dividends, you'll continue growing your share count even if the market pulls back more, giving you another way to build your account over your 5-year timeline. Of course, without seeing the rest of your portfolio, I don't know if you're already using dividend funds elsewhere. If your goal is to allocate $8,500 to $10,000 specifically to mid-caps, you can disregard that suggestion. If you're open to using options, there's another way to build your mid-cap position while generating some extra income. Step 1. Move your funds to IJH. Instead of XMHQ and SPMD, consider IJH, an S&P mid-cap ETF that trades below $100 per share, has options activity, moves in alignment with the other mid-cap funds. By switching to IJH, you'd still have exposure to mid-caps, but you'd also gain the ability to sell options for additional income. Tax note: if you're investing in a taxable account, selling XMHQ at a loss could be beneficial for tax purposes. I don't offer tax advice, but depending on your situation, this loss might offset gains elsewhere and reduce your 2025 tax bill. Step 2. Use covered calls for income. Once you reinvest in IJH, you'll own enough shares to sell covered calls to generate extra cash and reinvest the premiums to grow your position. This approach gives you another income stream while waiting for the mid-cap market to recover. Let's walk through how to execute this strategy step by step. First, buy IJH. I'll show you how to place an order for IJH shares using the $8,500 that you have available. This will ensure you have enough shares to start selling covered calls. Once we own the shares, I'll demonstrate how to sell a covered call, selecting a strike price and expiration date that align with Don's long-term strategy. I'll add this trade to my spreadsheet so we can track the potential outcomes. We'll look at the premium collected, the cost basis adjustments, and returns that you might receive if you set your trades up this way. This will give you a clear picture of how selling options can boost returns while still maintaining a mid-cap position. Let's jump into the demo now. With $8,500 available, I'm going to buy 137 shares. I'll expect a debit of $8,484 and some change. Now I'm going to sell a covered call with a strike price of $65. I'm choosing an expiration date in April rather than March because there is an ex-dividend coming up in March, and I don't know whether that date is going to be before or after the March 21st option expiration, so I'm going to go out to April to make sure that I capture the dividend in March. And if you look, the last dividend payment was 26.69 cents per share. So I'm going to estimate that dividend at 25 cents a share just to be conservative about my expectations. April 17th, $65. There is a bid of 35 cents a share. I'm going to see if I can get, let's try for 42. That filled at 48 cents per share. And that means that another $48 came into my account, which is enough to pay for one more share. I just bought 137 shares, paying $8,484.91 for them. Then I sold a covered call expiring April 17th with a strike price of $65 and brought in another $47.34. And I used that income to offset the cost of adding one more share to the position, paying $61.90 for it. So when I add up all of my expense and income, and then I divide by the 138 shares that I now hold in this account, my average investment per share is $61.59. I know that sometime in the middle of March, I'm going to receive a dividend reinvestment of at least 25 cents a share times 138 shares. And that will be enough to probably add about 0.5 shares to the account. So once I add another half a share, I will own 138.5 shares. Now, let's look and see what could happen on April 17th. If the share price is above $65 a share, say, for example, it's $66 a share, I will be required to let go of 100 of my shares, receiving $65 per share. So that would be $6,500. But if the share price is below $65, none of my shares will be called away, and I will still own 138.5 shares. So if those shares are called away, I will have bought shares, received options income, bought another share, and sold these shares for about $300 more than I just paid for them. So at that point, my total out-of-pocket would be $1,999.47, and I will still own 38.5 shares. And my average investment per share will be about $51.53. But if the share price stays below 65, I'll still own the shares, and I can just sell another covered call expiring the next month and bring in another $40 or $50 or $60. So Don, now that we've looked at both strategies, buying and holding versus using options, I'd love to hear what you decide to do with your position. Are you sticking with XMHQ and averaging down, adding SPMD, or are you open to trying the option strategy with IJH? Let me know in the comments or send me a follow-up question. I'm happy to help you think through your next steps. And if you are curious to learn more about safe option strategies like covered calls and cash secured puts, check out my beginner's guide to safe options trading. It walks through the basics step by step so you can decide if options are a good fit for you. I'll drop the link below. Thanks for watching, and I will see you in the next Eyes Wide Open Viewer Trade Clinic.